Hello, I'm Laura Monfredini, an Executive Vice President and General Counsel here at the Federal Reserve Bank of San Francisco, and welcome everyone to Ask the SF Fed. This is our second event in a series of discussions on economic topics impacting Americans. Before we dive in, let me provide you with some background for those of you who are new to the Federal Reserve and what we do. We have a mandate from Congress that is referred to as the dual mandate, that is stable prices and maximum employment. The SF Fed represents 9 states in the Western District, which is about 1/5 of the country. And we are a nonprofit public service institution supporting the economy through economic research, banking supervision, community development, and education. We spend a lot of time listening to people across our district to understand economic conditions. Conversations like Ask the SF Fed are a part of that effort. With me today is Sylvain Leduc, Director of Economic Research here at the San Francisco Fed. We thank all of our guests watching us from universities and institutions around the world, and a special thanks to those of you who submitted questions. We received upwards of about 200 for this session, and we are using them to guide the conversation today. Before we go any further, though, I do want to remind our audience that the views expressed during our conversation are mine or Sylvain's, and they are not intended to represent the views of the Federal Reserve System. With that, let's turn to today's topic, labor markets, inflation, and the economy. Sylvain, why don't you go ahead and start us off with a bit of context about current conditions in the economy?
Sure. So first, it's great to do this again.
It's fun. It's nice to see you.
Yeah, terrific. I first wanted to thank everyone who submitted questions. I mean, we got, as you said, over 200 questions. We can't address all of them in half an hour, unfortunately, but I have read through all of them. And some of them were really, really good and made me think it's really important for us to know what's on people's minds. So thanks for being interested in the topic. So let me just give a brief overview of where we are right now. So, I think the 2 main themes is inflation is really coming down and the economy remains solid. So as you know, the Fed has been really focused on bringing inflation back down to a level consistent with price stability. So 2% inflation on average over time. And we've done this by raising rates, trying to moderate growth without creating a recession. So a so-called soft landing. And I think the data so far is cooperating, and the odds of achieving this have really risen over the past few months. So first thing to look at is to look at inflation. So I'm going to just plot here 2 measures of inflation. The first one, the blue line, is headline inflation, so total inflation in the economy. And so you can see that before the pandemic, like all this period here, all this period was basically hovering just a little bit below 2%. So we're basically at price stability. And with the recession and with the pandemic, inflation just shot up, and rose to basically, let me see if this works here. My pen doesn't work, sorry about that. It basically rose to 7% about a year and a half ago in the middle of last year. And since then, inflation has just been coming back down. It basically fell by half, and we're now at 3.5%. So an amazing amount of progress in a year and a half. That measure, that blue line, often has a lot of volatile components. You can think about food, energy prices, they go up, they come back down. And so often it kind of blurs the signal we get about where inflation is going. So we like to look at a measure that's called core inflation that strips down these volatile components. It removes food and removes energy, for instance. So that's the green line. And you can see that over the past couple of months, this thing has been coming back down, okay, but much less than for total inflation. And so there's progress that we've made, but there's still a whole lot to be done. You can see that we're still way above our target of 2%, so we have some work to do. But at least things are moving in the right direction. The other thing that's interesting is that households and businesses are kind of optimistic about the outlook. So if you look at this, so the blue line is for businesses and the green line is for households. So there are surveys out there, and they ask people, what do you think inflation is going to be, in this case, in a year's time? And so you see that a year and a half ago, it was really high. It kind of ballooned, and people were worried that inflation would be here to stay. And by now, they're much more optimistic. Inflation is what they're seeing in terms of expected inflation for a year ahead has really come back down to more or less where we were before the pandemic. So these levels are about where we were just before, hovering a little bit below 3%. So this is really positive to see this. So people are seeing the Fed react to the inflation number and have confidence that inflation is going to come back down. The other thing that is interesting and positive is that households are putting the pandemic behind them. Okay, so this is showing a chart of the consumption in real terms of goods and services. And so what it shows is that with the pandemic, the consumption of services basically collapsed. So that's the green line. And we can go we can go to the theater, we can go to the restaurants, and so we consume way less of that. So the green line went down. We also consume less goods, but we switched over time. We started consuming, furnitures to put back in the home, gym equipment, so on and so forth. And so the blue line shot up above where it was before. And since then, there's been this normalization. Okay, so the blue line has been coming back down to trend, and the green line is also rising. So we're consuming more services than we used to during the pandemic, and we're consuming less goods. So consumption patterns are just normalizing, and that's a positive development also. And what's interesting, and we're seeing these effects in sectoral inflation rates. So let me just show two graphs here. So if you look at the consumption, the inflation rates for goods, this is this chart here. So it moves around. Let me see if I can get my pen to work here. It moves around zero before 2020, before the pandemic. Okay, so we have a little bit of deflation, but basically no inflation in that sector. So the inflation rate for goods shot up to 10% after the pandemic, and it was kind of scary time. We weren't so sure it would be coming back down. And since then, it just evaporated. It just came back down to where we were pre-pandemic. So extremely positive. Part of it is the Federal Reserve increasing interest rates. A lot of those goods you'll buy on credit. You can think about financing cars, financing the purchases of durable goods. So interest rates are higher, so it's more expensive to finance those. So demand is moving down. Some of it also is supply. So we're having, we suffered through supply chain disruptions during the pandemic, and these have really eased over time. So there's more supply. So less demand, more supply. Prices in that sector are falling, and we see this in inflation rate declining. Okay, so very positive in this sector. So if we move to services, though, services also we've seen some improvement. So you see inflation rising a lot after the pandemic to about 6%. Since then, it's declining, but much less than for goods. And part of the reason here is that the sector is much less sensitive to movement in interest rates. Okay, so you're often not financing the consumption of services by borrowing, typically. And so it takes more time for increases in interest rate to filter through and impact this sector compared to the goods sector. So it'll take some more time for inflation to come back down, but we'll need to bring inflation rate in services down to hit total inflation to be 2%. So more work to be done for sure. And all this progress that's happening in terms of inflation is occurring against a backdrop of a solid economy, which may be surprising to some extent. So here I'll just show employment gains. Okay, so the columns, the green columns here, are just the monthly gains in employment, and you see that this fluctuates a fair amount. So it's easier to concentrate on a moving average of those gains over time. So that's the dark line, and that dark line basically shows that there's been a step down in the pace of employment gains over time. And that's what we're looking for. We're looking for a moderation in the economy and a better balance in the job market, and we're seeing this. Although there's still some fluctuation. Last month, we created over 3,000 new positions. And so the economy, that's a big number. The economy is still very solid. You see the same thing if you look at different indicators of labor market performance. You could look at the unemployment rate, and we're seeing unemployment rate near historic lows. So the labor market is very strong, but overall, inflation's coming back down. The economy continues to be resilient, and the odds, I would say, of a soft landing have increased, but we're not quite there yet.
That is really encouraging to hear how inflation is moderating. Let's turn to the questions that we got. The first was really about timing and how long will it take for total inflation to come back to where it was before the pandemic? And also, what is your outlook for economic growth?
Yes, so let me move to this. I'll just show the forecast, give you a few numbers here in terms of the forecast from the research group at the San Francisco Fed here. I'm going to show a few things. So if you concentrate on the first line, headline PC inflation, so our forecast for that, I think the overarching theme here is that it's going to take time for inflation to come back down to 2%. Okay, so if you look at the first line, we're in the low twos by 2025, but to get really back to 2% is later than that, 2026. So it takes some time to do this. In terms of growth, if you look at the second line, we're seeing growth moderating next year, about 1.3%. So potential growth here, we have estimates that are a little bit less than 2. So we see us growing at below potential for at least a year before it picks back up. And with that, as growth is moderating, we see the labor market weakening a little bit. So the unemployment rate rising to 4.3% next year. So there's going to be some pain in the labor market that's going to come with that, but we're not foreseeing a recession at the moment. So there's still risk, but we're not seeing a recession, at least in our outlook. There's certainly risk out there. We're looking at what's happening in commercial real estate across the country. We're looking at what's happening in China. They have problem also in their real estate sector that could spill over into the U.S. We're monitoring those risks, but overall, we're seeing an outlook where inflation is going to take some time to come back down, but without having a recession.
Very good. Speaking of risks, there's a lot in the news right now about labor strikes in the auto industry, in healthcare and entertainment. What impact might those wage negotiations during those strikes have on inflation?
Yeah, so I mean, clearly the auto sector is one sector we look at because it's an important one. Mm-hmm. And we saw this during the pandemic where disruption in that sector kind of spilled over through the rest of the economy. We see this in inflation rates, for instance. And so we clearly pay attention to what's happening in that sector. We look at what's happening in terms of wage negotiation. But clearly what we're focused on is what's happening at the macro level. And if you think about wage growth at a macro level, what we're looking for is wage growth that is consistent with price stability. So one way to think about this is to think about workers. What do you want? So you'd want to be compensated for how good you are in your job, like your level of productivity, and you'd want to be compensated for inflation. You want what you earn to preserve its purchasing power. Right? So if you think about that, about how good you are on average for the economy, you think about average labor productivity growth. Okay, so that's about 1%. And then price stability would be 2%. So if you add the two, you'd want wage growth to be about, roughly speaking, 3% year on year. And that's the green line, that's 3%. Turns out that during 2009, wage growth was about that, 2.9%, and we had about price stability also. If you look right before the pandemic, actually, we had the same thing. We had wage growth around 3%, and we had a really good economy with inflation about 2, maybe slightly less than 2%. So that's what we're looking at. We're paying attention to what's happening to the auto sectors and to the strikes, but really we're focused to the broader economy and wage growth in the overall economy.
That makes sense. So I understand the labor supply is also a factor in influencing wages. Why are there still fewer people in the workforce than there were before the pandemic?
Yeah, okay, so great question. So let me put this chart here. So this is the overall participation rate, and it's indexed at the start of the pandemic. And you see the big decline in participation with the pandemic. Okay, so it was scary time. People didn't want to work. We were shutting down the economy. There was no work to be had, so people would just stay at home. You see that since then, it recovered some, but hasn't recovered completely. Okay, so we're still below where we were before the pandemic. And it's not clear we will go back. Okay, so to think about this, I think it's instructive to look at it in terms of of age groups. Okay, so if you look at what's happening for older workers, so those that are 55 and older, you see that with the pandemic, so the gray bar, you know, the labor force participation for older workers has really declined, and since then hasn't really recovered. So we know like the population is aging, and some of those workers will leave the workforce. That's just understood. But during the pandemic, also, I think what happened is that there were early retirements. It was kind of a scary time to be working. Some people decided that, you know, maybe better to call it off. You know, those workers could be coming back. You know, they're still young and could still work, but it's difficult. This is a lifetime decision. It's difficult to reverse often, and so we're not really expecting big movement in the yellow line. What's interesting, though, is if you look at younger workers, so those between the ages 25 and 54, you've seen a big recovery. Those have come back. You know, so you saw the decline early on in the pandemic in the green line, but since then it's fully recovered, the losses in participation rate. And what's more, if you look by gender, that's really, I think, interesting. So the yellow line is for female and the green line for male. Both of them declined during the pandemic. But you see that for female, it declined much more. The yellow line has cratered much more than for male. And so it was concerning, you know, like, so women had to often leave the workforce to care for, you know, education for kids and also for ailing parents. And you know, the concern was that once you leave the workforce, often for women, it's difficult to re-enter. But we haven't seen this now. Like we've seen the participation rate for women to come back and fully recover the losses that were experienced during the pandemic. So that's extremely positive. And this increased supply will help with our fight against inflation.
Oh, that's great to hear and really interesting. You know, we got a lot of questions about jobs in the labor market. You know, what are you seeing? Is it still a hot job market right now?
Yeah, it's still a hot job market, maybe a bit less so than it was a year ago. There are different measures to look at. We like to look at the measure that looks at the demand versus supply of workers. So we like to look at a ratio that depicts the number of vacancies that firms are trying to fill compared to the number of unemployed workers that are trying to find a job. So they're kind of trying to find this match in the labor market. And so you see this series, that's exactly showing this ratio between the two. And so the series about 1 right before the pandemic. Okay, so basically a labor market that looked roughly in balance. And then the series declined with the pandemic as firms basically didn't have to post vacancies. They weren't trying to find workers as we were shutting down the economy. Since then, this series has risen to a level of about 2, a little bit less than 2. So basically there were 2 open positions for any unemployed workers trying to find a job. And so in that sense, the labor market looks tight. Okay? For companies, it's difficult to find workers. Okay? And since then, it's rebalanced a little bit. So we're more towards level of 1.4, 1.3 than closer to 2. So the labor market, it remains tight, but less than it was a year ago.
Got it. We also received a lot of technical questions.
Oh, no.
Yeah, here we go. A lot of people asked about the inversion of the yield curve and what that means with respect to recession risk.
We're going to talk about this now.
We're going to talk about this now. Can you go for it?
Okay. I've got 5 minutes. It should be okay. Okay. So this is an interesting topic. We've done a lot of work here in the research department about this. 2 things to maybe keep in mind when we talk about this. So I'll walk you through. Hopefully, I'll be clear. 2 things to keep in mind. The first one is that financial markets are forward-looking. So when they're seeing risk in the future, it gets priced in today. Okay, so that's the first thing. The second thing to think about is that typically long-term rates are higher than short-term rates. And the way to think about this is, okay, so if you want to go buy a house, you want to finance this, you want to get a mortgage, if you get a 30-year mortgage, the rate on that mortgage is going to be higher than if you get a 1-year mortgage. Okay, and the idea is that for banks, for lenders, it's much more risky to lend for a long time period than for just 1 year. Okay, so then long-term rates are higher than short-term rates typically. Okay, so I'm saying typically, and this is a chart since the 60s about this difference between long-term yield and short-term yield. So long-term interest rate minus short-term interest rate. And you see that most time, I've got the zero line here. Most of the time, the yields are positive. Okay, so that makes sense. Like it's just what I described. But not all the time. And you see that sometimes it turns negative, that the long-term interest rate is lower than the short-term interest rate. Okay, big deal. Just so happens that that's the case basically before every recession. So the dark gray bars are recession periods. Every time that the yield curve inverts, we have a recession following after 6-7 months. Okay, so it's kind of a good indicator. In economics, that's probably the best indicator you can get out there. Okay, so what's happening? So why that's the case? So think about an investor, and I told you, like investors are forward-looking, and risk in the future get priced in today. So if investors are anticipating that we have a recession or a slowdown in a few quarters, what are they expecting? They're expecting that likely the Fed will lower rates to try to mitigate the impact of that recession. And because they're anticipating lower rates in the future, it gets priced in today, and the 10-year yield declines. Okay, and so that leads to an inversion that ends up predicting a recession. So that's the main story. So then you can ask me, okay, right now, we see the inversion of the yield curve. It's really pronounced, and we've had this for a while now. So what's happening? How come I don't have a recession? How come I don't have a gray bar right here? And that's because there's nothing structural about the relationship I just told you. I'll give you another story that I think that's what explaining what we're seeing right now. So the other story is that investors are kind of optimistic about inflation. They're seeing inflation coming down. They think it's going to continue coming back down. And hence, they're thinking that the Fed will be able to lower rates in the future because inflation is coming back down. And that, again, gets priced in today, and it's lowering the 10-year rate, and it's creating an inversion. But for completely different reason. It's not necessarily indicating a recession risk. It's kind of a more positive view. It basically says, inflation is going to come back down. The Fed won't have to keep rate so high in the future. So, we still need to watch this. Clearly, I think that is a good explanation for why this is happening right now. But, we could be wrong. But I think that's the right, of the two explanations, that's the most likely.
That is so helpful.
Is that okay?
Yeah, that was good. The yield curve, I think, is tricky to understand and can be really hard to interpret. So I appreciate that. What else? I assume the yield curve is not the only thing that you're looking at to gauge risks to the outlook. What else are you looking at?
I mean, basically, we're looking at all the data all the time. So we look at a lot of inflation data. Consumption is really important, 2/3 of the economy. So we look at several indicators of consumption. One tricky part of this is that these indicators often lag. We receive them with a delay, and so they're kind of backward-looking in a sense. And so to get a better picture of the economy, we try to complement those with by talking to people in the community, by talking to businesses, and seeing what they're perceiving on the ground. So that's really important. We also look at financial data because financial data tends to be more in real time. So that, like the yield curve is a good example. But we'll complement this, for instance, with labor market indicators. So for the recession risk, we might look at initial claims for unemployment insurance. So if the economy is weakening, people are losing their jobs, they'll file for unemployment insurance, and we'll see this in this chart. So you can see that with the pandemic in 2020, unemployment insurance claims just shot up. And then it came back down as the economy did better. And if you look at what's happening right now, it's pretty flat. We're not seeing this as indicating an imminent recession.
Got it. Well, we have time for one more question.
1 minute for one question.
1 minute for one question. And we got several about whether or not the Fed will raise its inflation target from 2% to, say, 3%. What are the odds of that happening?
Yeah, so we kept the most controversial for the end, clearly. Okay, so this is also a pretty technical question. There's a long answer, there's a short answer. The long answer, I clearly don't have time for that. There's a lot of good economics behind it. The short answer I'll give you, and it's coming from my boss, my ultimate boss. So Chair Powell at the Jackson Hole conference in August basically said that 2% is and will remain our inflation target. And I think that's basically what we need to know, so that the odds of raising the inflation target are basically zero.
Well, that is all we have time for today.
That was great.
Sylvain, thank you so much for sharing your insights. And thank you to everyone who attended today's event and submitted questions. We hope it was informative. Sylvain's charts are going to be available on our event page, and we also invite you to subscribe to future Ask the SF Fed events. Please share your feedback in a post-event survey that's also on our event page. See you next time.